afternoon, everyone. Thank you all for coming in and joining us for another exciting weekly Wednesday webinar, 3 p.m. edition or noon edition, I guess, if you're on the West Coast. 2 p.m. for those that are in Central Time, like our very own Kerry Lazard. So again, for everyone that is joining us, please get comfortable. We have an amazing presentation for you all today. Most important, we have a special guest who will be leading this presentation. For many of you, he might be a familiar face. For others, he might be new to you, but he is about to take you in a journey for what a lot of people, I'm sure if you're like me, probably have a lot of questions, and that is annuities. So if that is what you're here for today, you are definitely in for a ride. Thank you again for everyone making time. We know everyone is busy, and you all made time for us here for us to do this presentation. So again, get comfortable. We're going to give everyone about another minute or so here, and then we're going to go ahead and get started. And hopefully, you will probably walk away with something that you didn't know, or if you already knew, you're probably going to reinforce all the knowledge that you have when it comes to annuities. So again, get comfortable, get your drinks. If you are in the West Coast, probably this is your lunchtime. So if that is you, bon appetit. Also for us in the Central Time, right? I mean, it's 2 p.m. I guess that's still lunchtime, right, Carrie? Would you consider 2 p.m. still lunchtime?
I don't know. Arthur makes me be back from break at 1:30.
Okay. That's fine. That is fine. So again, we do see there's still people coming in. So we're gonna wait one more minute, and then we're gonna go ahead and start with the official introductions. A pretty small team. I guess I can start with that, right? We do have a small team today. You probably wonder where's Eddie, where's Yarnika, or Andrea, or even Kim Fridley. Well, the answer to that is we actually have a huge event that is taking place today in DC. It's the Congressional Baseball Game. So half of our team, it's actually about three-thirds of our team is actually in there at the event today. So that's the reason why they couldn't be here with us. But we definitely miss them. And I know that they're going to be doing an amazing job at the Congressional Baseball Game. So, but like always, we always like to give them a shout out because they're part of this amazing family, the weekly Wednesday family. And with that being said, I know we want to be mindful of everyone's time, especially of our presenter. We're going to go ahead and start here with the introductions. You already pretty much heard her name, and that is Kerry Lazar from the marketing team, the person responsible of putting all this beautiful content for us. And today she's actually going to be playing the role of Andrea Londono, which is reading the questions towards the end. And that is also a great reminder that if you have any questions during this presentation, please don't hesitate to use the chat feature or the Q&A. We will do our best to answer every question before we let you go this afternoon. And I guess everybody already knows me. I always forget to introduce myself, I guess. But my name is Milton, and I oversee the business development unit here for the credit union. And I'm really excited to be part of this panelist. But the middle of the hour is none other than Mr. Michael Schimmel from Fellows Financial, who is going to take us onto this beautiful journey of annuity. So, Michael, you want to take it away from us?
Thanks, Milton. Thanks, Kerry. Good afternoon, everybody. Again, my name is Michael Schimmel. Been with Fellows Financial Group for the last 8 years. Most of that time have been working with members like yourselves at the credit union to give sound financial advice based on what your situation is and kind of what is best suited for you. And so today, there's always a lot of questions about annuities and understanding them. And today we're going to go about through annuities, how they work, what they are, things to look out for, maybe some myths. But today is about information. And you've probably heard before from friends, family, this person got an annuity, it was awful. This person got an annuity, it's good. Look, annuities are just, solutions that give you lifetime income potentially, or give you a level of protection that you couldn't get somewhere else. A lot of you may have worked for the federal government. The FERS pension is a type of annuity. Any pension payment is a type of annuity. So there's definitely a reason to have them maybe as one of the solutions in your retirement planning. Doesn't mean that everybody should have one, but understanding them is key. And so today we're going to go through that. And again, we're going to be monitoring the chat and the Q&A. If we don't get to it right away, we will get to it definitely before the end of it. We're going to try to keep this timely. And there's some things from if you were at the previous one that we did before, some new information that wasn't available before, and just how new annuities are sometimes being used, and just a good refresher. So we're going to jump in. All right. So this is me. We're not going to spend too much time on that, but my contact information can always be accessed after this. It will be in the chat. I'm sure Carrie will be putting that up shortly, but you can also access the United States Senate Federal Credit Union website. And I'm under there under our partners program with Fellows Financial Group. So moving forward, annuities, are, can be based for retirement. They are long-term investments most of the time. They help you look at the volatility in the market and reduce it potentially. They also, can influence the accumulation, and that accumulation may or may not keep up with inflation. So you always want to look at, hey, are we in a high inflation environment, low inflation environment over the period of time you're looking to do an annuity, because it does have a real effect. Market volatility and how well you're protected is something to look at. So why do people look at doing an annuity? Well, annuities are a contract with guaranteed language in there for protection, potentially income, death benefits, things of that nature. And annuities fill a gap because most companies do not offer pensions anymore. And so what annuities do is kind of create a private pension. And as retirees are living longer and needing income to last longer without market fluctuation risk, annuities are a popular place to look and evaluate if they're right for your individual situation. What they do give you is income stability, and they also help hedge your risk for longevity. And you can get potentially lifetime income or period certain income. You can get different riders. There's all sorts of features that can be inside annuities. And what annuity is right for you does not mean it's right for your neighbor, your family member, or anything like that. But there are some definite positive opportunities to gain from having an annuity. There's also some downside, right? So liquidity, maybe inflation, adjustments and things of that nature. So the fee structure, all of these things you want to evaluate inside an annuity. So let's talk about it a little bit more. I've kind of alluded to some of that, but an annuity is a contract with an insurance company. All annuities are contracts with insurance companies. They provide typically a retirement stream of income, or they will provide guarantees against loss over a certain period of time. Most of them are funded through lump sums or a series of payments. More often, you see current day annuities funded through lump sums, whether it's from savings, whether it's from a 401k rollover, whether it's from just cash accumulated from other means. They are normally funded through lump sums, but do not have to be. They are designed to really take your savings today and provide you with a steady income if you want income, or a guaranteed floor on investment loss or no loss. Depends on the annuity. So you can have income protection, or you can have your capital protected, or sometimes there's a combination of both. So it really depends on what you're looking for and how this little piece of your portfolio will complement your plan and your other parts of the portfolio that you have. So how do they work? So normally you have to purchase an annuity. Annuities can be 3 years, 5 years, 7 years, 8, 10, 12, up to 12 years normally. When you purchase it, normally in a lump sum, the contributions are invested. They might be invested in S&P indexes. You might be in QQQ, NASDAQ. You might be in a proprietary index, which is a combination of multiple indexes that the insurance company makes. What you have entered into is a contract, and that contract will dictate what your benefit is. Hey, you do not have a risk of principal loss, during that period minus any cost, or you have a guaranteed income stream that will go up over, 8% per year every year that you do not take income, and then that income is locked in for life. So there's a lot of opportunities for you to tailor what the annuity is to your situation. And with that said, there's different types of annuities. So you've got immediate annuities, you've got deferred annuities, fixed annuities, variable annuities, index annuities. You also have RILAs, which are registered index linked annuities, which aren't on this slide. So, immediate annuities mean, hey, I'm going to enter into this contract and I'm going to start getting maybe an income stream right away. I don't have to wait a year or 3 years or 5 years. I'm going to create basically a private pension through the insurance company for the rest of my life. Deferred. A lot of these are deferred, right? You go enter in the contract and you have it accumulate through investment returns or guaranteed returns through the insurance company. And then you turn on the income at a later point in life. Maybe there is no income and maybe you're protected for 6 years, right? And then you can take out the money and do something else with. There are fixed annuities. Fixed annuities are like CDs. However, they're issued by insurance companies. They're also referred to as MYGAs, MYGA, and you can always get a 3, 5. They even have 1 year, but it's not great. But 3, 5, 7 years are all available out there through insurance companies like CDs. But again, you don't have FDIC insurance where you do have that with CDs. Because of that trade-off, you sometimes get a little higher of a rate. You also have variable annuities. Variable annuities are annuities that have the insurance wrapper around them, which makes them tax advantaged, right? Tax deferred. That money's growing tax deferred, just like you have in an IRA or your 401k. But inside, you have stocks, bonds, high investments that can have a high rate of growth. Variable annuities used to be the only way that you would have an annuity 15, 20 years ago. Nowadays, variable annuities are actually somewhat rare unless you want significant growth, unless you are purchasing it earlier on in life, not in your 60s or your 70s or 50s, where the true goal is growth inside of it, but the fee structure can be a little higher. Sometimes that fee structure is worth it because you're deferring for a long period of time. There's also indexed related annuities of FIAs, fixed index annuities that they're called. They're tied to market-based investments like the S&P, a proprietary index, NASDAQ, Russell 2000, things of that nature. All of these things, they operate generally in the same way. It depends if, hey, do we want payments right away? Do we not want any payments? If we don't want any payments, what are the guarantees on my principal? So it really depends on what annuity is going to fit your financial plan the best. So once we figure that out, then we look at funding it. So funding it can happen in a variety of different ways. Like I said earlier, most of them are funded with a lump sum payment. That lump sum payment can be maybe your savings account that you've accrued over a number of years. Rates aren't great. I want to invest it a little bit in the market. So I'm going to put 100,000 into this annuity for a 6-year period of time. And my losses are protected from the market, but I could also have some upside. So that's a way that you can make a single premium lump sum payment. You could also do it by rolling over an IRA or a 401k into something because you want maybe a cash to come in every month, right? An income stream. So that could also happen where it's funded with a lump sum, and now you can create an income stream. There are annuities that allow you to fund on a annual basis. Those are less and less available today. They've just kind of gone out of favor from the insurance companies and from the public, but there still are a few out there. And then people who maybe just are sick of the market risk, we've had a tremendous run in the market and they want to protect some of their assets. You can always transfer the money from your investment account, your brokerage account into an annuity. Once it's inside an annuity, it is a tax deferred growth opportunity for you. You could, depending on the annuity, have guaranteed income for retirement. Most annuities, you will not access retirement money till 59 and a half. If you access money from an annuity before 59 and a half, you'll receive a penalty. So we don't want that, right? So this is a retirement longevity vehicle. But variable annuities, sometimes people will do in their 40s, maybe late 30s. But then you are focusing on growth. You're not focusing on income right then. Most people will utilize annuities, whether it's variable, fixed index, immediate, for income guarantees or generation in retirement as a supplement. It is not going to pay for everything because you don't want to put all your eggs in one basket. But it's a diversification technique where, hey, I've got this asset over here. It's growing tax deferred, and I'm going to turn on income a little later. Oh, by the way, it also protects me from market downturns. Now, we've had a tremendous market over the last 15 years with some bumps in it, significant bumps, but we've come right back. Could we have another 2008? Hopefully not, but that is a real concern, especially for somebody that's coming up on a retirement. So an annuity is a way to have potential protection from market downturns. There's no IRS annual contribution limits, right? IRAs, you've got a limit. Roth IRAs, you got a limit. You can put as much money into an annuity as you can within reason, right? You don't want to put all of your assets in an annuity, but you can put a significant portion in. So you don't have to worry about restrictions from the IRS on that. Annuities also can be used for specific legacy planning, next generation planning, generation skipping planning, things of that nature. Ways to maximize maybe a death benefit for somebody who can't get traditional life insurance. So there's a lot of flexibility and customization inside the annuity chassis. They are not one, with a broad brush fits all. They're very specific, and finding out the right one that coincides with your goals and maybe the gaps in your retirement planning. So how do they work? Well, annuities grow. They can grow with guaranteed interest. Simple. Hey, we're going to guarantee a 5% rate of return for the next 3, 5, 6 years, kind of like a CD, right? Those are the fixed index. You've got variable, which have, you're choosing individual stocks even. You could choose individual indexes, but those are truly based on market performance, and they normally don't have caps, right? So you could get all the market performance, but on a variable, you normally can get all the downside performance. The big advantage on a variable annuity is it's all tax deferred money. So normally people that are utilizing variable annuities are utilizing it with cash that is not in a tax advantaged account. You also have indexed annuities, which are tied to proprietary indexes or general indexes like the S&P, the NASDAQ, but they normally have caps or participation rates. Now they're cheaper than variables, which is appealing, but you might be in the S&P 500, but have a cap up to 12% each year. And so if the S&P did 17, like it did last year or more, well, you only get 12. So, but on the flip side, if the S&P went down 7, well, you get a 0. So it depends on your situation on what is best, but there is different abilities depending on the annuity you choose to have different levels of growth and different levels of protection built in. So why else, we're doing annuities. We're normally doing them for some level of protection or future earnings. And so you've got these options in front of you, and those are the payout options. Lifetime income is by far the most common. And you can also get joint lifetime income, just like in a pension, right? You can have just yours, but if you pass, does the pension stop? You could, or you elected to maybe to have your spouse, whoever that is, or your next of kin receive that pension or annuity for a certain period of time. So you've got some flexibility in regards to the payout options. Period certain, I talked about. So some people will get a higher level of payout if they only say, hey, I only want to guarantee that I'm going to get this income for 10 years or maybe 20 years. But after that, if I die at year 21, pension stops. But if I die at year 10, my beneficiary gets 10 more years of payments, basically in a lump sum. So that's period certain. There's joint and survivor, right? We kind of talked about that. You pass away, keeps going on for your spouse at the same level. It's unreduced 9 out of 10 times in most annuities. Whereas when you're doing that with a pension, normally you're taking a lower payout for your survivor. There's also lump sum or withdrawals, right? Most annuities have a 7 to 10% penalty-free withdrawal per year. So it allows you some liquidity, but not huge amounts of liquidity based on the money that you put in. But at the end of the term, the surrender period, which all annuities have different levels of surrender periods, you're able to take your money out and reinvest it somewhere else. You don't have to keep it in an annuity. The only time you have to keep it in an annuity is if you're under 59 and a half. So if you're in 59 and a half and you already put in an annuity and it matures before you're 59 and a half, well, guess what? It needs to go into some other type of annuity. Otherwise, there's a penalty in there. So we don't want that. But there's a lot of options out there, and even there's some additional protections. Some annuities will have a certain level of healthcare payment assistance in regards to if you were disabled, if you can't access two of the daily living activities. So it's not true long-term care, but it is a long-term care like benefit that is sometimes in those. So for people that can't get life insurance, for people that have some maybe chronic condition, annuities can be very valuable in that side on top of the payout options that are out there. And are you getting all of these options for free? The answer is no, right? There's always some sort of fee structure involved. It all depends on the value that you're getting. So most annuities have a contract period, 5, 7, 9, 12 years. If you try to leave the annuity ahead of time, there are penalties. It's normally a percentage of the premium, the lump sum that you put in if it was a lump sum. Normally you don't want to leave, right? Because they are, substantial, 5, 10, 12%, depending on how long of a term that you originally contracted to. You do get that annual free surrender charge percentage. So that's always something to keep in mind. There are sometimes annual maintenance or administrative fees. Those should all be disclosed to you when you're looking at these and evaluating them. Investment fees. Normally, there's only investment fees on variable annuities, but it is something to look at if you're looking at an immediate annuity, if you're looking at a RILA, if you're looking at a fixed index annuity, is you always want to look at the fees. Is there a fee for the rider? Is there a fee for just having the annuity? Riders are additional options. Do you want a long-term care rider attached to the annuity? Do you want a spousal rider, right? So it all depends. Some of them have fees for things, some of them do not. So these are all things that you want to take into consideration when you're looking at them. And one of the best ways to really do this analysis is look at it in context of your plan. Do you have a written plan with your financial advisor? If not, I'm here as a resource. We can always do that for you. Look at your plan, see where the income's coming from, because your paycheck's going to stop, right, when we're planning. So where are we going to create that income? And how are we going to solve for market downfalls, and turn downs? How do we make sure that we're keeping up with inflation, things of that nature? So it's all about the cost benefit analysis to make sure that this is taking care of that one part of your need in your financial plan. So what else do we need to consider other than fees and charges? Well, another big one is tax treatment. So the treatment for annuities is deferred, which is great because taxes can automatically take 22 plus your state. So, 28, 30, 36, 40% of your investment returns away right away. So when you can defer that, you've got compounding effect happening on the full dollar amount, which leaves you with a larger dollar amount long term. Taxes on withdrawals, if they're coming from any annuity, normally, if they're a traditional annuity, whether it was pre-tax money or ordinary income, it comes out as ordinary income, right? So that is normally the highest tax bracket. Cap gains would be better, but it's not. It's taxed at ordinary income. And if you inherit an annuity, it's taxed as ordinary income when you get the lump sum from the beneficiary. So you want them to understand what the tax impacts are of having an annuity. Still, even though there is with any investment, it still could be the right decision for you. As we talked about earlier, 10% penalty before 59 and a half, that's kind of a norm, but always want to be mindful of that if you're doing an annuity for whatever reason before age 59 and a half. The other thing about it is annuities nowadays, there are some companies that can help facilitate Roth conversions. Roth conversions, the reason I put it under tax treatment is, well, whenever you do a conversion, you owe tax on the conversion. Well, inside an annuity, you can sometimes get an offset that helps make up for that tax that you had to pay for the conversion. So we'll run through an example in a little bit. But with any annuities, any decisions, financial decisions, you always want to do the risks and the considerations analysis, right? Look at the surrender charges, early withdrawal penalties. Look at the liquidity. That's why we never recommend you put a huge portion of your net worth in them, right? These are complementing products, right? Maybe 20, 25, maybe 40 if you're pushing it. But you got to understand what your liquidity needs are. You got to understand the fees. You got to understand the ins and the outs of how these things work. And that is best done when you've got a trusted financial advisor running through this, because that advisor should be very knowledgeable about all the different annuities out there, and there's a lot. And if you as an individual are trying to decide between two or three and just kind of searching online and doing ChatGPT or Claude, or it's kind of overwhelming. And there are key things to be looking through and looking for, along with, hey, is this company that I'm buying an annuity with, this insurance company, is it rated well? Is it going to be here in 5, 10 years? If I want lifetime income, 30 years, right? So that is a risk, and we got to understand those risks, right? So you want to look at, do some research on that side of things. You want to look at the diversification that you have. Okay, I've got this much money that I'm looking to put into an annuity. I've got this much money in the market. I've got this much money in CDs. I've got this much money sitting in my savings account. Highly recommend engaging a financial advisor like myself. We deal with them day in and day out. Does that mean every client gets an annuity? Absolutely not. It's got to make sense for that person. But you really got to understand your liquidity and your plan around liquidity if something crops up. And if something does crop up, where could you get hurt with the surrender periods if you're within it? So that's always something to take into consideration. All right. So do they make sense, right? We're going to go through some examples of, some situations on where they could go, right? Pre-retirement, near retirement, in retirement, and then a little Roth conversion example that I'm going to show. So in pre-retirement, we've got Marcus. He's maxing out his retirement accounts and he wants additional tax deferred growth. So what does he do? Well, he wants market risk because he's comfortable with it. He wants those higher returns. He's looking for an income stream eventually in life, but he doesn't need it now. He's got at least 10 years, 9.5, for that money to grow. A variable annuity could be one of the best options for him because he wants tax deferred growth and he wants to grow it in the most advantageous way. Variable annuities are set up to do that, and you can turn on an income stream later. But you have the full market performance up and down. So for him in this one, who wants market performance, who's maxing out his other tax advantaged accounts, this could be the best option for him. Then we've got Carla, 55, nearing retirement. She recently received $100,000 from an inheritance. She wants to grow her savings with market link potential, but she doesn't want any risk of loss, right? She's risk averse, at least on this money, and she wants to retire in 10 to 12 years. So something of that nature, an indexed annuity would be best. Normally, they have a guarantee against market loss, and she's got the ability to grow it up to a cap inside because it's an index annuity that have caps or par rates, but it's allowing it to grow without market loss. Each year it locks in, or each day, depending on the annuity. So one that might be good for her to consider would be an indexed annuity. Maybe we've got somebody in retirement, David, 68. He's got a $150,000 lump sum from a rollover. He's comfortable with his other income or assets that are outside of there, and he wants to create another income stream. So he doesn't have to worry about, what's coming in, can I take more or less as the market goes up or down? He's not going to be contributing to retirement accounts anymore. So for him, who wants to create an income stream, an immediate annuity might be the best solution to create that income right away. You don't have to wait 2, 3, 4, or 5 years. It's going to start day one once he rolls it over and enters into the contract with the company, and probably has guaranteed income at a certain level for life. Now, today, the only disadvantage of immediate annuities, a lot of them are not indexed for inflation. So say today he's getting $1,000 off that 150. Don't know. I'm just making this totally up. Well, $1,000 today is not going to be as big as $1,000 20 years from now. And he could easily live to 88, right? So you got to understand, okay, this money's great now. You also have to have market linked investments to counteract the inflation. So as I alluded to, sometimes you're going to be looking at, annuities, and you've heard about Roth conversions, and annuities actually can help with Roth conversions. So we've got Alice here. We gave her an age range, but she's got about $500,000 in retirement money. That's all pre-tax. We'll just say she's got a pension already from the federal government, and she really just doesn't need this money because she's got her pension and her additional savings, we'll say in the, in the first pension from FERS, and then she's got TSP money. And these were just additional accounts that she had. So she doesn't need it, but she wants to protect her assets from future taxes. And she wants to look at, hey, how do I give my grandchildren or my beneficiaries this money in the most tax efficient way? She doesn't need this money definitely for the next 5 years. So one of the best options could be a Roth conversion. And Roth conversion, as I alluded to earlier, is, you have $100,000 today. You want to convert it to a Roth. You'll pay your full tax the year you do the conversion. So if you did $100,000 and your tax bracket between federal and state was 30,000 of that tax would be gone, and you would have left $70,000 in your Roth account. Now that money can now grow tax-free for the rest of your life, and then when you never use it and you pass on, guess what? It goes to your heirs tax-free. That's the only way IRA money goes to your heirs tax-free, is if it's in a Roth. Traditional IRA, there's no step-up in basis, fully tax ordinary income to your beneficiaries, and they have to take it within 10 years unless you're a spouse. So it's important to think of, is a Roth conversion the right one for you? So I just want to go through a quick example. So in here, we've got scenario A, which is pay taxes on the conversion and you get a bonus, which is a premium bonus. So in the example, you pay roughly 18% in federal due to the conversion. You purchase this annuity and you get $82,000 in it. Well, you're getting a bonus for purchasing this. So that bonus is 23%. So you've got your initial premium that buys the annuity with 82 because you use the rest of the money to pay your taxes. But then the annuity company gives you the bonus, which makes you whole and then some to 108.60. Now that 108.60 is fully invested in the market and will continue to grow from that point inside that contract. And then you can access it depending on the contract when it ends, or you can create an income stream from it later. The same company, you can do that multiple years, but instead of having 3 or 4 different Roth IRA accounts doing the conversions, you're doing them in different years and therefore lessening the tax burden each year and therefore making it more efficient. So this is just a quick example, of ways an annuity can actually make you whole, overcoming maybe some of the tax burden that you lose, that you actually have to give away when doing this conversion. But if you're younger, maybe there's a bucket of money that you have in an IRA that you're not going to need. This is a great way to really provide tax-free income to yourself later in life, or to pass on income to your generation, to your beneficiaries in the next generation. So a few things to consider before buying, right? What does your retirement income picture look like? Everybody's got to do their own analysis. How much money, income per month, per year do you need? And then how much do you want guaranteed? What risk tolerance do you have? Are you willing to ride things out? Or do you want a certain portion of your income guaranteed? Maybe an annuity makes sense. What is your time horizon? If you're 80, maybe not. If you're 50, kind of a sweet spot for looking and investigating annuities. 40s, there's got to be a good reason. 60s, definitely within the wheelhouse. 70s, you're starting to look at it. But, we got to make sure it's the right solution because you got to look at liquidity. You want to look at affordability. You're losing that money is no longer accessible without a penalty. So can you afford to put that money inside that annuity, whatever type of annuity is, for that benefit? And then always look at the tax implications, right? It's going to grow tax deferred, but when it comes out, what's going to happen? Is it going to come out over lifetime income payments? Is it going to come out as a lump sum? That is going to be important to understand that tax impact. So what do people do if they don't want an annuity? Maybe they decide, they do the research, they don't love it for whatever reason, which is fine. What are some alternatives? Well, you've got income funds. Income funds are normally based on dividends or government securities or bonds that can create nice income. REITs, real estate investment trusts, are a good way, but they all have market variability. If somebody tells you can't lose money in bonds, they're incorrect. You can definitely lose money in bonds. And same thing in, REITs, same thing. If you want a CD, great. But there's a reason you don't get the best rates in CDs because your risk level is super low. You can look at bonds. Like I said, you can get municipal bonds. Those are tax-free. But again, you've got some market risk with that. You also have inflation risks with bonds. Stocks, you got market volatility. Historically, they are the best suited to cover and overcome inflation effects. CDs, like I said, you might get a nice steady rate. You've got FDIC in coverage or through the Federal Credit Union coverage, but you're not going to get the highest rate of return. So it depends on your financial plan if you can take that. If we're in a high inflation environment, CDs might not be the best solution. And then you got your retirement accounts, 401ks, IRAs, 403bs, etc. Do you have money in those? Should you keep money in those? How is the money inside of those positioned? All of those things are opportunities outside of an annuity. Where we see annuities work best is when somebody wants or has a need for a certain solution that annuity provides, and then only a portion of their portfolio is allocated that way to hedge that risk. So it can easily provide steady income. That's the key takeaway from this. there's very different annuities. We have just kind of touched on them, and I know we've got lots of questions on there, but we want to just give you a taste of like, hey, annuities aren't for everyone, but when they are used properly and when they are done correctly with proper planning, they can be a powerful hedge and a powerful investment for you that has a lot of tax advantages or income advantages or just peace of mind advantages. There's different types, pros, cons, costs. You always want to investigate that. Some of the alternatives that we just went through have more flexibility that maybe you need. Maybe you don't need it. It depends. And as always, you always want to consult a trusted advisor. I'm partnered with the credit union. We've been working together for the last 8 years. I have an open door in regards to conversations. Always willing to do that. Our job is not to sell widgets. It's really to provide sound financial advice and look through, as with any advisor that you have, look through the pros and the cons, look at the costs, and look at the long-term benefits according to your individual financial plan. So if anybody wants to connect with me, like I said, my information's on the website. Here it is, right here. And then would really love to open it up to Q&A and the comments, the chat. I know there's a bunch out there, and we'll get going.
Well, thank you, Michael. Wonderful job. And thank you, everyone, for the questions. I'll jump right into it. Does the annuity go back to my estate upon my death?
So normally the annuity, you're going to have a beneficiary in the contract. That doesn't necessarily go to your estate. If you don't name a beneficiary, yes, it goes to your estate, but you normally want to name a beneficiary.
Is there a minimum amount that needs to be put into an annuity?
Depending on the annuity, the answer is yes. Normally it's, 25,000, I think. The fixed annuities or MYGAs, which are like CDs, it's a lower dollar amount. I think it's $1,000 for some of those. It really depends on the product and the insurance company that's providing the product.
Can you avoid taxes on interest from a fixed MYGA annuity at the end term by rolling it into something else?
Yeah, so if you roll any annuity into another annuity, you're continuing the deferral. But if your annuity is in an IRA, ultimately when you pass, there will be taxes due. If it's a same thing with it's taxed as ordinary income. Same thing with taxable income. All it is deferral.
All right.
You don't get a step up in basis in your fixed annuity.
Does the federal government monitor or otherwise regulate the annuities industry? If so, are federal reports and ratings available?
Yeah, so the federal government will provide, through FINRA or the SEC, provide some sort of level of guidance. However, because these are issued by insurance companies, normally it's the states that regulate the insurance companies. That being said, all of these insurance companies have ratings by the rating agencies, Fitch, Standard & Poor's, et cetera, that will give you a rating agency kind of outlook on, hey, is this company AAA, A plus, A minus, things of that nature, which will help. Why that's important is you don't want to be dealing with somebody that's got a B minus credit and may be out of business. If you do, the insurance companies are normally backed by that state's reinsurance. I've never heard of anybody losing money in an insurance contract like an annuity because normally they're bought either by the state or another insurance company that will honor the benefits.
What percentage of a person's portfolio would you recommend investing in annuities?
Oh, that's a loaded question. It's really very specific to that person's outlook, right? I mean, somebody could be so risk averse that they it really fits them best to put as much as the basically regulators will allow, and that would be like 75% probably is max. Um, that would be pushing it in my mind. It would have to be a very specific situation. Normally, you kind of see about, anywhere from 25 to 50% is the average if for people that want to utilize annuities, whether it's for income, whether it's for protection, whether it's for growth. Just depends on their full financial kind of makeup. Do they have a pension? Do they not? Is there an inheritance coming? What liabilities do they have? There's a lot of things, longevity that play into that.
This might be a good time to add that I shared Michael's contact info and calendar link in the chat. It takes us a couple days to get the webinar recording ready, but I will send it by email along with Michael's contact info and the slides. But again, it'll be like a day or two until the designer gets it all ready, but I'll share it for sure. Michael, if you can you get an immediate annuity at 45 if you spread the money out over your lifetime?
Uh, you can get an annuity at 45. You can buy it. Um, you don't want to start taking income because it's a 59 and a half. Otherwise, you start getting penalties. Once it goes into an annuity, you got to wait till 59 and a half.
Okay. Once you invest in an annuity, is it best to stay in them even if we are not close to retirement age? Meaning by moving away from a 7-year annuity, am I losing benefits by exiting it completely?
If you're below 59 and a half, there's definitely repercussions, right? If you're leaving the annuity, we'll call chassis. So you want to make sure that that's the absolute right decision. Sometimes it still can be, but there will be some tax implications if you're below 59 and a half. If you're above 59 and a half and your maturity on the annuity is 7 years and it ends, then you're fine. You will that if it's a after tax money, the money that comes out of it, the growth will be taxable and you'll have ordinary income to pay on that. So maybe you don't like the current annuity you're in, but maybe it's better to look at rolling it into a new one that maybe fits your financial plan better. So that one's a hard one. That one I would say, case by case basis.
I had a traditional 401k and a Roth 401k from an old employer, which I used to fund a 403b and a Roth a Roth individual retirement annuity, both of
Mhm.
which I contribute to monthly. What are the differences between a regular Roth IRA and a Roth individual retirement annuity?
Um, so my guess is you're probably a TIAA client. A lot of those are 403Bs, given their likelihood to be in the teaching profession. But you've got, so they automatically will put some of your funds into an annuity. That's just a part of how they do the plan. Roth annuity, Roth for I'm looking at it, 403B or Roth IRA. None of those are going to be taxed ultimately at the end. So if you have a Roth annuity, the growth, you're kind of double dipping unnecessarily because you already have the tax-free money. It's already in a Roth. It doesn't need to be in an annuity unless you want the other advantages of an annuity, which is, uh, you know, downside protection, guaranteed income, things of that nature. But all of the money that's inside the Roth, period, no matter if it's a Roth IRA, Roth annuity, Roth 401k, the money that comes out of it, as long as it's after 59 and a half, should not be taxed.
So would you say annuities are for the more conservative, risk-averse investor?
You see a lot of people with that kind of mindset do have annuities. However, even people that have a risk on kind of attitude, you can't, well, you shouldn't ever be 100%, equity, especially in your 50s and 60s. You just don't know what's going to happen ahead of time. And, we saw in, '08, a 40% downturn, and it took 2 years to get back to even. So if that's in retirement and you have all your money, well, that's a significant lifestyle adjustment that you have to do. So even the most aggressive, I would say it's appropriate to have different buckets of money doing different things. So you have a diversification, which then what does that do? That decorrelates your portfolio, right? So if stocks are going up, that doesn't mean this is going up, right? So you almost want almost a negative correlation where two things happening in the same direction aren't going to create the same result.
Is there a risk of losing funds invested in the annuity when you die, or are the funds always available to the beneficiaries or estate?
So depends on the annuity. So annuities got, and some people just still don't like them, which is fine. I'm not here to bang the drum on annuities, saying they're the best things in the world. But what I would say is annuities got the bad rap. Um, a long time ago, if you got an annuity and you died, all the money stayed with the insurance companies. That is not how annuities are today. So as long as you have a beneficiary, it will go any cash value left in the annuity or a death benefit will go to your beneficiaries. If it goes to your estate, it will flow to your estate and it'll go through probate and the beneficiaries will have to do that. The key thing to think about, depending on the annuity, is what is the actual contract value? Because in a lot of annuities, not to get in the weeds, there's a contract value and there's an income value. Your income value is what your income for life is based on. Your contract value goes down every time you get a payment. So at some point, your contract value will go to zero, but you'll still receive income. But when you pass, there's no residual money to go to your heirs if you live long enough. And if you live long enough, guess what? That annuity was perfect for you because you were using their money for multiple years. It's okay that your beneficiaries didn't get it. Now, if you set this up so your beneficiaries would get money, well, then it's not. So it depends on how you want, what do you want to happen for your beneficiaries really dictates what product or solution you should be in.
All right. About the age 59 and a half rule. I thought
Yep.
that I read that if you spread the payments over your whole life, it's okay. You can start taking it out. Is that incorrect? The annuity would be financed with regular money from an inheritance, not a retirement account.
I'd have to double check. Not a CPA. I'd have to look at that one.
Okay, we'll wait. Just kidding. Okay. Just a couple more. Is there an age limit on annuity with bonus for IRA conversion?
Um, no, generally no. There is a 5-year look back rule that the IRS has. So you want to, if you're 90, and you die at 94, well, then it's like you never did it. Um, so doing it earlier is better, but most companies will not do an annuity past 80. There are some companies that will do them at 85, but it's pretty rare. 80 is kind of your just kind of standard number.
Great. A lot of people say thank you for the presentation, Michael, and very informative. And then the last question I'm seeing is there a fee for your services? Can you talk about that for a little bit?
Yes, sir. So we're partnered with the credit union to have, a few meetings, consultative. We want to make sure that there's an opportunity for us to answer your questions and provide value. If you want to keep working with us and you want to utilize our services, whether we help you with planning, investment management, maybe we help you pick an annuity because that's what you want and you're here today to think about it. We get paid directly from those carriers. It's a flat fee. You don't pay us anything. So I'm happy to talk more one-on-one in regards to the fee structure. But right now for the first meeting or two, that is an investment that we do in you as members. because of the credit union relationship, but also that's generally how we just want to treat clients and develop that relationship.
All right. Do you see any question? Oh, last question. Would you say then we should start taking money out from an annuity at 59 and a half?
Not necessarily. I would say that it depends on kind of your overall financial profile. If you want to, depending on what type of annuity you have, maybe it makes sense to turn it on at 59 and a half so you don't have to use other assets. Sometimes it's better to let that grow, depending if there's an income bonus or income jump. Some annuity contracts will have guaranteed income growth of like 9% per year up to 10, 12 years. That's guaranteed income growth where, can you do better in the market guaranteed over the next 10, 12 years? I don't know, right? So it's a decision that you need to make in context with everything else that's going on. Most people will not turn on their annuities at 59 and a half. Normally they'll turn them on mid 60s, early 70s, mid 60s too. So you don't have to turn on Social Security, even though we got that wonderful news about the Social Security Administration running out of money. Yeah, not totally, but a 22% reduction if there's nothing that happens. So this is a way to supplement some income. And, it's peace of mind. It's something that's not connected to the government. It's something that's connected to an independent company. So some people like that as peace of mind as well.
Awesome. Well, thank you so much, Michael. It seems like you know a thing or two about annuities, so we truly appreciate your expertise. It is always a pleasure to have you here with us, and as you can see, all the interactions that we have from everyone that attended. And again, if you want more of a one-on-one conversation with Michael, please do not hesitate to reach out to him. You can actually find his schedule on our website. I believe Carrie put a link on the chat, so if you want to use that. Also, we're going to be sending a copy of the presentation along with the recording, like Carrie stated. It's going to take a couple of days for us to have it live on our social media platform, also on the website. So if you want to go back to and watch this recording, you're more than welcome to do so. But most important, if you want to know more, or perhaps having a specific question that you were a little shy to ask here in public, reach out to Michael. He will most definitely take care of you. So as always, Michael, it is a pleasure to have you here with us. Very informative, and we truly appreciate your expertise.
Thanks, Milton. Thanks, Carrie. And thank you, everyone. Appreciate it being with you here today.
Awesome. And then before we let everyone go, just a quick reminder, we know that you all enjoy coming here with us on to our weekly Wednesday webinars. Just want to remind everyone that next week we're going to go back to our regular time, which is 6 p.m. Eastern time, and we're going to tell you all about what's the road ahead. And when we say the road ahead, we know it's summertime, so we know that this is the time where a lot of people are thinking about perhaps getting a new car, or if you bought a car recently and you're not so happy with the rates, maybe the rates have dropped. So come and see us next week. We're going to tell you all about auto financing, vehicle protection, and most important, what are some of the summer savings that you could potentially be leaving on the table. So with that being said, Michael, Carrie, as always, we appreciate you all, and we'll see you again here on another weekly Wednesday webinar. Have a wonderful rest of your day, everyone.
Take care, everyone. Thank you.